Hey, this is Hutch, and today we're going to talk about taxes. Specifically, we're near the end of the year. It's the middle of December. We're going to talk about moves you can make right now in your portfolio to better position yourself when doing your 2021 taxes and also beyond that. Usually I find that people get in this kind of hamster wheel with their account of give me some deductions this year, give me some deductions this year, give me some deductions this year. But there's things that they're doing that are actually hurting their chances of future deductions. So it's like you got one foot on the gas, one foot on the brakes. So we're going to talk about some things you can do immediately, but also think about the long ball picture as well. So with that, let's jump into, this is a lot. This is the old and new tax brackets. Over on the left was before the Tax Cuts and Jobs Act taxes. That's when Trump changed the tax brackets at the end of 2017. That was enacted from 2018 and set to sunset and go back to these at 2025. So we're going to put these aside for now, and we're going to focus on the 2021 brackets. Now, there's ordinary income brackets, and there's married filing jointly. There's individual, all the single ladies. And then there's also long-term capital gains tax rate, and that's assuming you've held a position for over a year. So the tax rates are different, and there's an opportunity depending on what you're doing. But first, let's just talk about the ordinary income tax brackets. Now, with enacting the Tax Cuts and Jobs Act, there was a new 12% bracket. You can see in the past, it went from 10 to 15. After $19,000, it went to 15%, all the way to 77. They adjust these thresholds for inflation. Not exactly. There's a lot of inflation right now. But now that second tax bracket goes all the way up to 81,000, but you only get taxed 12%. And so a lot of you that maybe got laid off during COVID and hit it big with crypto and didn't really go back to work, you want to make sure that you're absorbing at least this 12% bracket. So this is how much you can absorb if you're married. This is how much you can absorb if you're an individual. And so maybe it's okay to harvest some gains if you want, or maybe you have some gains in something like ADA, Cardano, and you've been dying to get out of it, but you think, I don't want to pay the taxes. And this is not investment advice. You have to do your own research, but maybe you wanted to get into some Luna, but you just didn't want to pay those taxes. Well, even if it's a short-term trade and you haven't absorbed all of that 12% bracket, maybe that's something you want to do. Or maybe you have a job like the frogs working at McDonald's or whatever your job is, and maybe you absorb all the way up to 81,000 at your job, or 100,000. But notice that the next bracket is only 22%. And again, it's 3% off from what it was in the past. And it goes all the way up to 172,000 if you're married, 86,000 if you're single. And notice that the next bracket is only 24, and that goes all the way up to 329,000. Now, there's some other things you need to think about, such as the net investment income tax and the 199 cap A threshold that I'll talk about later on in this video. But I just want you to see that maybe there's an opportunity to pay some taxes on sale now, because what it was in 2017, just going up to 237, it was 28%. And then it was 33 halfway into that 329 that you can get now for 24%. So there's some savings, and there's probably a few reasons, like 30 trillion reasons, why the government may need to raise taxes in the future. And this is simply for American taxpayers. I'm sorry, I'm not that versed in taxes outside of the U.S. But this is a very interesting slide that I'm an ex-financial planner, that a former cohort showed me, the U.S. national debt to GDP ratio. So if you think about it, GDP is everything we make or produce, right? It's like credits and debits. That's credits, that's stuff that we're doing, and debt is obviously stuff that we owe. Back in World War II, we leveraged up our debt to, go to war and save the world. And the debt to GDP ratio got to 119%. Now, if I go up one slide, we can see around the same time the highest marginal rate, now we showed there was a lot of brackets, but if you were in the highest bracket, taxes got up to 80 and even north of 90%. So much so, I love this story, that it was said that Elvis got to the point where he would only do one record or one movie a year because the second one, he was giving 90% to his silent partner, his Uncle Sam. Jack Nicklaus, the famous golfer, the reason he got into course design, there's Nicklaus courses everywhere, was because he needed deductions. And business owners had a lot more deductions. They do now, they did then. And so he could offset some of this with the deductions he had as a business owner. Fast forward to now. Well, in this slide, by the way, I made this during COVID, back when I was TradFi financial planner. It was estimated that at the end of 2020, we would be at 125. Now, keep in mind, we pumped a lot of money into the system, and there wasn't a lot of stuff happening. Nobody could go to restaurants. Pretty much people were going to the store and buying toilet paper and food. Like, that's it. Maybe a little bit of gas. But the GDP went down. The debt went up. I think it was probably over that. I don't know the exact thing. But what's so scary about this is when we overlap the highest tax bracket after the last time we did this, and we see that it went down, and even though everybody thinks this is so high, these tax brackets, and then this has happened to our economy, and right now we're in this money printing phase, this is a little scary if you're a U.S. citizen. And so we're going to talk about some things you could maybe do with a Roth IRA in a little bit. But what I'm saying is whereas your traditional mindset with your CPA is get me deductions, get me deductions, get me deductions, maybe you want to start thinking about how to absorb some of these 10, 12, 22, maybe even 24% brackets, whether you're married or single, and accelerate some taxation, whatever that looks like. I don't necessarily, again, this is not financial advice. I don't recommend selling your Luna because it's going to go up, and that's gone up, and maybe you have gains. But again, maybe there's some other coins where you have gains, but you just didn't want to trigger the tax. Maybe this is the time where you accelerate gains, you harvest those gains and kind of pay these taxes on sale. It's kind of like paying off the mob early to reallocate to whatever you really, really want to be in. And I also have later in this video a cool idea on how to maybe create some losses to offset that. I also want to talk about, again, people that maybe got laid off, didn't go back to work, maybe didn't generate a lot of income with trading, maybe live very modestly. A lot of people don't know there's a 0% capital gains rate. And for all the single ladies, it's 0% for your first dollar all the way up to $40,000. 0% capital gains rate. So that is very attractive. Let's say you were just living off top ramen and tuna fish and living very modestly, and you wanted to monetize, to recognize some gains. Well, you don't even need to accelerate that income, right? If you've held it for over a year, you could take up to $40,000 of winnings off the table and pay no taxes. If you're married filing jointly, it's 80. Now, note that these are an aggregate. So if you're working and you're already making over $40,000, it's not going to work. But if you don't have any income, or say you only have $20,000 of ordinary income, then at that point you could take $20,400 of long-term capital gains and pay no long-term capital gains tax. Between 80,000, if you're married, and 500, the capital gains rate is 15. This doesn't include over here, like this footnote, it doesn't include, there's that special 3.8%. It's called net investment income tax, otherwise known as the Obamacare tax. And so if you're married, it's anything over 250. If you're single, anything over 200. So even though your rate is 15 from 40 to 445, if you're single, after 200, it effectively becomes 18.8%. And if you're a consultant, or you get paid 1099 income, or you're self-employed, you're not a W-2 earner, there's also something called the 199 Cap A. And it's a really unique deduction in that most other deductions, if you want a deduction, you have to kind of you have to do something with money to get a deduction. Like, I want a deduction, so I'm going to put money in my 401k and kind of send it to prison until I'm 59 and a half. And by doing that, by parking that money there, I get a deduction over here. Or like if you're a business owner, you buy a piece of equipment. You have to kind of buy this thing, and hopefully it's a useful piece of equipment and not just a boat anchor. But by buying this thing, I get this deduction over here. Or people like to buy the heavy 6,000-pound vehicles. I pay money for this thing, and then I get this deduction. What's unique about 199 Cap A is with the Tax Cuts and Jobs Act, it essentially says if you're self-employed or you get K-1 income, meaning you have an S Corp, an LLC, and it's just a pass-through, not W-2 payroll income, but you're just getting paid this kind of pass-through self-employed income, or you are employed and it's K-1, there's thresholds, and I'm going to take all these same brackets and thresholds and put them in more of a visual theme. So this is the same thing we just looked at, the 10% bracket, right? That's if you're single, that's if you're married. The 12, that's if you're single, that's if you're married. The net investment tax threshold, like I told you, it's 250 over here. It's 200. You can see the numbers are different, right? This is just showing the pyramid of the different brackets. Well, the 199 Cap A threshold is if you make up to 164,000 if you're single, or almost 330 if you're married. So your wife or your spouse could be employed and say make 100 grand a year, and you make 150 grand a year as a consultant or whatever. You have your own business, your own S Corp, and you get some payroll, but a lot of it's through K1. Essentially, 20% of your self-employment or K1 or pass-through income is just not taxed. You don't need to buy a boat anchor. You don't need to put money into some kind of 401k. It's just 20% of it is not taxed as long as you don't exceed these thresholds. So be mindful of that as we're doing some of these strategies. What's nice is even if you wanted to fully absorb up to the 24% bracket, which ends at 329,850, just so happens the 199 Cap A threshold ends right before that. Or it doesn't end. It actually gets phased out for about 100 and something grand, but it gets watered down above that. So you could realize and get 20% off your self-employed income all the way up to married filing jointly, almost $330,000, which is exciting. And same thing, the 199 Cap A threshold ends right before the 24% bracket. So something to be mindful of if you're trying to accelerate these gains. Pretty cool. And notice if you're single, you don't even hit that extra 3.8% of net investment income tax over and above your capital gains tax. You do, though, if you're married filing jointly. So, again, if our example, maybe you guys make 200 grand between yourselves, you can effectively absorb $50,000 to accelerate some gains of maybe some things you want to get out of. Pay 24% tax. Federal, there is state tax too. Again, it might be, our states need a lot of money too. So this might be paying tax on sale, and you just pay it on sale and you don't even incur the net, the 3.8 tax. Hope that was helpful. And even if taxes don't go up, even if for some reason we just kind of print our way out of this and they don't raise taxes on people in the future, these favorable tax brackets are set to sunset in 2025. Now, I put a footnote here because the thresholds may be a little bit different, but assuming they were exactly the same, we could just kind of look laterally like we did in the beginning and say, wow, the same area or the same threshold of income that I used to have, I used to pay 25% tax, now I'm paying 22 and 24 instead of paying 28 and 24 instead of 33. And, after this, it's not really quite as good. Once you get way up here in the nosebleed section, though, it's pretty good. Instead of 39.6 here, 35, 37. So even the super high earners, maybe there's a little bit of an opportunity there. Not quite as juicy, but definitely something to consider. And again, for those that, got laid off and never went back to work because they struck it big in crypto, be sure and absorb some of these brackets. You won't, after 2025, they won't be this good again. So take advantage of that. All right, so let's look at another opportunity that may help you do some reallocation without incurring so much tax, because maybe you don't have room in those brackets to absorb, but you still want to do the reallocation thing. So I don't know how many of you are familiar with wash sale rules in stocks, but it's essentially a loophole that the IRS shut down for stocks and securities. And what it says is, assume Janet buys a share of Company A stock for $2,000 on January 10, 2021, and on January 15th, Company A stock is trading at a much lower price of $1,200 per share. If Janet were to sell her position and buy another share, like sell one share at $1,200 and then buy another one right away, she would not be able to claim the capital loss of $800, the 2,000 minus 1,200 due to the wash sale rule. However, if we substitute company A stock with Bitcoin or any other cryptocurrency, here Janet would be able to claim the $800 loss as a capital loss, short-term or long-term, because cryptocurrencies are not subject to the wash sale rule as of yet. As we see down here, the Ways and Means Committee started to weigh in on this. So just to cut to the chase, if we get all the way down to timing, if the Ways and Means Committee suggestions are adapted, cryptocurrency trades occurring after December 31st, 2021 will be subject to the wash sale rule. This guy's very good, by the way. I'm going to put his Twitter handle if you want to follow him. He's had some great articles. I think he's called the Crypto CPA. But yeah, really good stuff. Again, this is not tax advice, and he's not giving tax advice, and nor am I. And it's possible that the IRS could even disallow this. They could retroactively kind of throw out the baby with the bathwater if they want to. They've done it before, but not all the time. Usually not. So I'm going to show you some moves that I'm going to make, and it does cost a little bit of commission and a tiny bit of slippage, but it's something, I'm willing to pay a little bit to go ahead and monetize some losses in some altcoins I have, and simultaneously do a round trip and maintain my exposure to the space, simply so I can create some losses to offset some of the gains I've made in my Luna moves. There's all kinds of different Luna moves. If you're not familiar with the Terra ecosystem, you should be. Definitely check out my video about 5 ways to earn income in the Terra ecosystem with Luna. It's a very robust ecosystem. There's lots of TVL. In fact, it just flipped Solana. It's got tons of developer activity. And so lunatics, if you know, you know. There's lots of Luna moves that you could be doing that may incur some taxable gains because Luna's been going up, even if they're just kind of seemingly like kind exchanges. If that doesn't fly, it may be useful to have some of these losses to offset against that. All right, let's just take QRDO. So after it had its run up, I got some here. I want to say after it flagged here, I got some in the 6s. It went up to 8 or 9. I might have bought a little bit more in the 7s. Then it totally fell from grace. And I bought some in the 5s and the 6s. Even got some close to 7s that I thought it was going to go. It came back down to under $3. Jumped back up. Came back down. Didn't buy any here. But now that we're at 12.14, I'm going to show you what the implications of. Let's sell $1,000 worth of QRDO. So we just sold it to market. And now let's buy, let's see, it's $4. Let's buy 250 QRDO. That's about $1,000. Let's just buy it. I'm just marketing in right now. So what did I just do there? I just sold QRDO $1,000 worth, bought about $1,000 QRDO. Let's see what that cost me. So you can see right here the buy of, let's see. No. Well, here, this shows 250 USDT cost me 50 cents, right? Cost me 50 cents. So that's just for a one-way ticket. That's just a buy. So let's just assume to sell it cost 50 cents. So it cost me $1 per 250. So if we just consider it was $4, right? $1 to sell 250, or see, 50 cents to sell 250, 50 cents to buy 250. That's $1 times 4 for 1,000. So $4 divided by $1,000. This is the percentage. It's cost me 0.4%, right? 0.4% for however much I sell. That's just a cost. You're welcome, KuCoin. That's just a cost. But by doing so, what did I do? I created capital losses. I maintained my exposure, and maybe for some crypto that I had going up, like Luna, or maybe I had to swap Luna for B Luna, or Luna for X Luna, and I wanted to make these moves, and that's a taxable event. I now just created losses for a very cheap commission to offset those potential gains. So I'm not for sure if this is going to hold. It's not tax advice. Everybody has to do their own research. But as of right now, there is no wash sale rules for crypto. The IRS can do whatever they want. They can retroactively say this didn't matter, in which case, what did I lose? I lost $4 per $1,000. But if it does work, what did I do? I just harvest. It's called tax loss harvesting. I harvested some losses against some things that may have caused me some massive tax. And instead, by doing that, what I can do is defer that tax into the future, because I don't plan to sell my Luna, B Luna, X Luna X for a long, long time. I can now defer that. And by then, I think there's going to be a number of different charitable strategies and other things I can use to offset that tax then. So hopefully this helps as a strategy. No guarantee it'll work. Do your own research, but something you may consider if you have losses in some of your other altcoins that you want to maintain full exposure to, and maybe you're willing to spend a few dollars to monetize and recognize these losses now to offset other gains, so you don't have to pay this tax that's just gone forever come April or whenever it is when you file your 2021 taxes. All right, so those were kind of the immediate moves. Let's talk about some more proactive planning we can do. And what I have in front of you is the history of the tax brackets, the highest in red and the lowest in blue, since the inception of the income tax, which started in 1914, I believe, around World War I, because we needed to fund the war. And you can see the highest income tax bracket went way up there. It was crazy. It was supposed to be a temporary tax. I've heard of saying there's nothing more permanent than temporary tax legislation. I don't think they're getting rid of it anytime soon, especially with $30 trillion of money printing and debt. Told my kids that are teenagers that you guys are already in debt about 75, 80 grand. You don't even have any student loans. You haven't even bought a car. At any rate, things went down during the Great Depression. Come World War II, the backup we talked about here in the 50s, and they started trending downward. When Reagan got appointed, we had the closest thing to a flat tax. I think he had two tax brackets, 25 and a 28. Then things trended up to 40, down to 35, up to 40, down to 37. What I want you to see is the lowest tax bracket has a very similar trend line. It's just a lot less volatile. When this goes up, so does this. When this goes down, so does this. It just trends exactly with it. It's almost like the lowest tax bracket is less volatile. It's like Bitcoin and red. The highest is almost like altcoins. And the reason is both parties have always vowed to kind of protect the lower class. They're going to go to where the money is. And so they're going to hammer the higher earners to pay down most of the debt. And they're going to have the lower earners, pay a token amount. But no matter how high taxes gotten, the lowest tax brackets have never been that penal. So there's an opportunity here. When you retire, it's common that people have, and this is something I call tax allocation. Everybody spends so much time on asset allocation, not enough time on what I call tax allocation. So you're getting into retirement. If you're getting into retirement now, that's great. But if you're getting here later, I think this is going to be like this, right? This is going to shoot up. Not only that, but the threshold, remember we saw all these kind of middle tier thresholds. There was like 10, 12, 22. I think this red is going to hit a lot lower. But they just need to. They just have too much debt. So regardless, most people have like a pre-tax bucket. Let's make this in black again. They have a pre-tax bucket of like a 401k or an IRA. That's terrible penmanship, Hutch. You have your IRA, and they may have something like a Roth, but usually it's not very much because it's hard to get money in those. Terrible penmanship. We've been involved in life insurance planning, so our clients is almost like a synthetic Roth to a degree without limits. It's not always going to have the sexiest growth potential, but it's a lot more stable. For me personally, I have stonks. I don't have a lot in the way of bonds. I have a few muni bonds. It's like my kind of last ditch what do you call it, emergency fund. But most of my kind of stable coin slash bond part of my portfolio is in the life insurance bucket that also protects my family and also acts as a hedge against future higher taxes. And now I have crypto, and I have crypto in taxable accounts, but I also set up crypto IRA. I wanted to set up crypto Roth, but I had Roth and actually in a Roth 401k, but my company 401k wouldn't let me do an in-service withdrawal. So I'm actually shutting it down next year. I'm going to get one more contribution, shutting it down, and I'm going to start a crypto Roth. And I'm going to talk to you guys about that in just a little bit. But for getting the setup and all the logistics, the idea behind having these buckets is you want to absorb money from this 401k and IRA that's never been taxed. You want to absorb it here. It'll spend more. You'll have to cash out less shares of stock or mutual funds or whatever you have in these 401ks and IRAs to equal the same amount of net spendable dollars. But if you get all the way up here, cashing out the same amount of shares is going to be less and less and less the higher you go, depending on what taxes are at that time. So I don't mind having money in the pre-tax, but I need to control how I turn the spigot on in retirement. I need to monitor this line and just take it right up to this line. And maybe there's a couple mid-tier brackets that I don't mind taking it out in. And again, that would include your IRA, your 401k, Social Security is going to be taxed. It's already, if you make any kind of money, it's already 85% taxable. It's probably going to be 100% taxable by the time you retire. And any crypto gains that you have in taxable accounts. So, but let's say you want to live kind of above the median income, and I think they're going to push the ugly brackets just right above the poverty line so everybody pays their fair share. Well, you need to have something like muni bonds, and I don't have a lot of long-term faith in them since interest rates are so low, and when interest rates go up, the value of muni bonds will go down. So I have my finger on the trigger to cash out those when that time comes. The life insurance, or you could have a crypto Roth. We'll just put Roth, and we'll put just the Bitcoin with the cute little symbol. But any kind of crypto in a crypto Roth. You want to have the foresight to do that now, so that when you come to retirement, you're not just reacting to it and it's too late. So let's just revisit. This is a good time to start considering that, because even though you can only put, 6,000 or so in a Roth IRA, or 19.5 in a Roth 401k, there's no limit on the amount of conversion. And so maybe you use up some of these brackets depending on where you are to say, you know what, I'm going to go ahead and pay taxes on sale. And this is a grid of a lot of numbers, but this analysis, the decimal figures represent the effect of deferring tax in an IRA versus accelerating tax to a Roth at various tax rates. So to give you an example, and let's look at the 20 instead of the 10-year, just to understand what this means. Let's say you convert at the 22% bracket, but you take it out at the 15% bracket. Well, that's not good. You're going to lose 27% of your wealth. You're better off just leaving it in the IRA. But let's say that you take it out in one of these higher brackets, like the 28% bracket, and you had it, you paid tax now at 22, you let it grow in a Roth. So your Roth's like this, you clip it for 22%, it grows. By the way, the assumption here is just 7%, which is very conservative for crypto, for a 20-year analysis of crypto. But if it just grows by 7%, like maybe it's just like a very sluggish Bitcoin portfolio, and for some reason the stock to flow model doesn't even pan out, but it just kind of slowly chugs along with inflation. You get clipped for 22%, allocated in something earning 7% for 20 years, and you take it out, and your tax rate at that time where you take out that particular pool of money, you're going to have 23% more than you normally would have. And obviously, if it's 22 and it's 35%, you're going to have 50% more net spendable dollars. That's what this means, right? And obviously, if you pay 35% and you're taking it out, it's a wash, same with 10-10. So hopefully you understand what this means, and you can sit here and freeze frame this and just play with it to your heart's content. But you get the point. it's worth paying off the mob early if you think something's going to grow, even in the 10-year period, to have it in a bucket that's never going to get taxed again. So what are your options here? Well, let's just look at good old Google. The main one is the iTrust Crypto IRA. Okay, so if we look at the iTrust, and I looked at this one, I didn't do it, mainly because, let's see, it shows me, see all available cryptocurrencies. I don't want that right now. So we see all these. It's a very, there's SHIB. There's all these coins and crypto we can get into. There wasn't Luna though, and so I didn't end up doing. Coming soon, Avalanche. Where's the Luna iTrust? If we look at the pricing, it's not cheap. It's a 1% trade fee. Oh, they changed it. It's a 0% $0 per month account fee. Used to be a little bit more. Now it's just a 1% trade fee. And there's a setup fee. Come on, maybe they just changed it. Regardless, you'll have to look more into this on your own. Let's look at the one that I did, Directed Crypto IRA. So directedira.com. Oh, and by the way, they custody with Coinbase. It's not your keys, not your crypto. It's technically not yours. You still have, you can do IRA or Roth, but since it's a government-sponsored plan, the exchange has your keys, and it's a trust for the benefit of you, whether it's an IRA or a Roth. With this, as you open a crypto IRA or a Roth IRA and fund your account, you authorize money to be sent from trading account to Gemini, and I have done this. I have it with just an IRA. I did 100% into Luna. I think I put about $25,000 to check it out. Wish I would have done more. When I look at click here for an official list, and it's not pure Luna, it is wrapped Luna. And so I realize that may not be a great solution for all of you, but there it is, Terra. And I did it in the 40s. And I want to say I got almost 500 and something Luna, almost 600 Luna in the 40s. But at least I just wanted exposure at that time. I didn't understand everything that was possible with the degen strategies. And I am now, I'm supposed to speak to one of the attorneys. I'm talking to these guys about setting up a separate one where you pay a little bit more. It's an LLC. Apparently this LLC can open up the wallet for you, and then you have kind of free reign to do whatever you want. There is something called UBIT though, unrelated business income tax, or UBTI, unrelated business taxable income, that you have to be careful of. So I'm paying for a consult to see exactly which of the degen strategies would incur UBIT. You can't use leverage in an IRA, so Anchor borrows off. That's out. Anchor Earn would be great. I mean, talk about a great bond portfolio. What about just putting a good amount of money in Anchor Earn? I mean, even if you wanted to insure it, apparently there's the is it Osmosis? No, it's not Osmosis. I can't remember what. Oasis. The Oasis version of Anchor's coming up. I mean, to have some bond yielding, call it 15%, fully insured, that'd be pretty cool for a portion of your retirement account. And eventually, unfortunately, my income, I'm still working, so I can't convert that IRA to a Roth. But once I get all my Luna exposure in a Roth, what I may go back and do in the IRA, in the IRA portion, remember I told you I bought Luna? I've heard a lot of people say, hey, you make your profit in alts, and I don't even consider Luna an alt anymore, but you make your profit in alts and you protect your profit in Bitcoin. I do believe in the decentralization of Bitcoin, and I do believe in it as a store of value. And I did sell off some of my Bitcoin to get into Luna, a decision I have not regretted. In fact, I wish I would have done more given the pair and how it looks. But what I may do with this IRA is just keep this, and then once I get my exposure, I could sell the Luna in the IRA. It's in an IRA, so I'm going to have to pay that 1% trading fee, but there's no tax. And then I may just use that to allocate to Bitcoin. So it's almost like, again, kind of that not the bond portion, but it's just a diversification and allocation in my investment pool. So hopefully this will help you think about how to position things. Again, there's not a lot of urgency here unless you can absorb some of these brackets now. Maybe you want to absorb it now to do a conversion, and you probably won't have time to set up the crypto IRA and then convert that, and that's kind of a pain. You're going to have to pay them twice. Maybe what you want to do is wherever your TradFi account is, so wherever you have your IRA, whether it's at E-Trade or Interactive Brokers or Schwab or TD Ameritrade, a lot of times it is very easy to just quickly set up an account on their DocuSign or whatever, just open a Roth, have them transfer everything from your IRA to a Roth before the end of the year, or however much isn't going to have you bump into the thresholds you don't want to bump into. Do that for 2021. And now you have a TradFi Roth, and you can take your time, and hopefully Luna and crypto or whatever doesn't pump too long, but at least you absorb the tax brackets before they go away, because once 12/31 comes, now it's on to 2022, and who knows what your income's going to be there. And so you get your conversion done on the TradFi side because it can be a lot quicker, and then you go ahead and start one of these crypto IRAs. Also, a lot of you that are following me may want to do the more degen stuff, and hopefully by then I will have more information on cost, benefit, what's possible, what's not possible inside that LLC, inside the wrapper of a self-directed IRA. That was a lot, I know, but listen, we don't put enough time into thinking about our money, and even in crypto, it's like allocation, trading, degen stuff. It's not how much you make, it's how much you keep. And so if you're subject to tax, if you're not fooling on, like I'm not fooling on, so if you're not fooling on, it's going to pay to take some time and think about not just asset allocation, but tax allocation. None of this is financial advice. You need to consult your own investment, tax, legal advisors. But I hope you enjoyed it. Talk to you soon, friends.